Hi, everyone. I want to thank you for joining me this evening. It's great to have all of you here tonight. I'm James, market strategist at Tiger Broker Singapore, and I'll be sharing the US market outlook tonight. My topic is, can the S&P 500 gain another 20% in 2024? Let me give you my conclusion first. It's a bit hard to gain 20% this year, but maybe S&P 500 can generate a modest return of 10% this year. And I'll be sharing with you the reasons throughout the webinar. Moving forward, I will try to conduct webinar bi-weekly. I will cover topics such as macro outlook, interesting stocks, and investment strategies, particularly in the US and Singapore markets. There is a lot to discuss tonight, but I will try to keep this under 30 minutes. There is also a Q&A session at the end of the webinar, and you can type your questions in the chat room. If I'm not able to answer all the questions during the webinar, please come back to the chat room 1 or 2 days later, as I will type the questions there, the answer there. Okay, let me go through the disclaimer first. This presentation is presented to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. Today, I will cover some of the catalysts that could drive the S&P 500 higher this year. I will also spend some time discussing the outlook for rate cut. Most importantly, I will provide you with my year-end target price for the S&P 500. Lastly, I will share some practical investment strategies to assist you to manage your US portfolio in 2024. Okay, let me begin with a recap of 2023 first. Basically, 2023 was a good year. Nasdaq 100 returned 55%. S&P 500 returned 26% in 2023. If your portfolio are not giving you the return similar to Nasdaq or S&P 500, I would think that it's because your portfolio owns something other than US equities that may have dragged down your portfolio performance. For instance, the STI index was giving you a 4.74% returns in 2023, whereas the Singapore REITs itself, right, is giving you 7% return in 2023. MSCI China provided a negative return of 11%, and the Hang Seng Index posted a negative return of 10%. If you are concerned about inflation in 2023 and have invested in gold or bond, gold itself returned 12%, whereas the investment grade bond returned 5.5% last year. And all of these asset classes are underperforming US equities last year. You might be thinking that since US equities outperform other asset classes or stocks in other countries in 2023, you may want to sell off US equities this year and invest more in other assets that underperformed last year. So, is it possible that US equities underperform this year? Maybe. I think no one can say for sure. However, I'd like to remind everyone that in terms of 5-year or 10-year annualized performance, US equities have a better track record. For example, the 10-year annualized return for the Nasdaq was 18%, S&P 500 was 12% itself. So I reckon the US equities should have outperformed in the long term. So it's better to hold more US stocks relative to other things in your portfolio. Anyway, I have also listed down all the ETF ticker here. So if you are interested to find out more of this ETF that's interesting to invest in, you can simply search on the Tiger app itself. Okay, let's talk about the US market outlook for 2024. Okay, some investors will look at the first 5 days indicator and predict that S&P 500 will not do well this year? To put it simply, the first 5 days indicator tells you that if the stock market ends the first 5 days, the first 5 trading days of the new year with a gain, it's likely to also end the year with a positive return 80% of the time. If you remember in 2023, the first 5 trading days ended with a 1.5% gain for S&P 500, and the entire year ended with a 26% return. But the first 5 days of 2024 ended with a negative 0.1% return. So the probability of ending this year with a positive return comes down to 60% from 80% itself. And these are some of the 2024 year-end target prices provided by some of the research houses itself. On average, the year-end target price for S&P 500 is about 4958 itself, representing a 3.9% upside compared to last year's closing price, or just maybe 2% upside compared to yesterday's closing price at 4868. So you may say that since there is limited upside on the S&P 500, and you may consider investing somewhere else itself. However, it's also better to take all of these target prices with a pinch of salt, as analysts frequently revise their target prices. For instance, UBS Jonathan Golub initially set a 2024 year-end target prices of 4,600 in November last year. In December, he adjusted the target price to 4,850, and today he revised it to 5,150. So analysts change target price oftentimes. We could also see that Yandere Research is the most bullish among all, forecasting a 5,400 target price. On the other hand, JP Morgan offers the most bearish outlook with a 4,200 target price for 2024 itself. I think the main key takeaway here is that most analysts, most research houses have given up a hard landing scenario. They are mostly expecting a soft landing at the moment. Before going into the upside catalyst for the US equity market, let's first discuss what could potentially upset investors in 2024. Firstly, investors are worried about a second wave of the inflation. So this red line over here show you that we are here now in terms of the CPI number. And some investors are worried about a spike in this inflation number triggered by geopolitical risks or Federal Reserve policy mistake. Some analysts reckon that we may see a second wave like what we have witnessed in 1940s or 1970s itself. I think it's too early to talk about that. And there are two reasons for that. Firstly, the largest trend here still indicates that the inflation is still coming down. Secondly, even if the inflation data such as CPI or PPI is trending upward from here, I would say that it would take many months of data to confirm that this is a second wave. So I don't believe that it's worth mentioning of a second wave at the moment. Some investors would argue that the inflation is currently at 3.4%, and the Federal Reserve prefers to see the inflation comes down to the 2% target price before considering a rate cut. I would disagree. I believe that as long as the Federal Reserve sees a good likelihood of inflation reaching 2%, and probably range bound around the 2% level in the longer term, they are willing to cut rates. However, they need to convince you, they need to convince the public that they are reluctant to cut rates. This is because to even have a chance of reaching the 2% target, everyone must be convinced that Federal Reserve is indeed hawkish. Because if Federal Reserve tells you that inflation is not a concern and they will be cutting rates soon, everyone will be spending recklessly and prematurely and causing the inflation number to spike up again. And I can tell you for sure that investors will be so bullish again and will be buying up stocks. So it may even create an equity bubble. So everyone need to be convinced that the inflation is a concern in order to even have a chance of reaching the 2% inflation target. All in all, I believe that Federal Reserve will cut rates this year, most likely in March, where we could witness the first rate cut itself. There are a few reasons for this. Firstly, I don't think that inflation is really that sticky, and economists are predicting slower real GDP growth this year as well. So if the interest rate really stay higher for a longer period, the Federal Reserve may even eventually create an economic hard landing itself. Secondly, this year is an election year, and Federal Reserve might want to cut rates sooner to give Joe Biden a boost with his re-election campaign, because it takes months for a rate cut to create a positive impact on the economy. It's not like cutting rates today will immediately improve the economy the next day. And the US presidential election is on the 5th of November, and it probably takes 6 months for a rate cut to really affect the economy. Hence, the Federal Reserve probably wants to cut rate in May or March. Personally, I still think that March is the most likely scenario. But based on CME Fed Watch, traders reckon that the Federal Reserve will only cut rate in May itself at the moment. And there will be a total of 6 rate cuts in 2024. This would bring down the interest rates to a range of 3.75 to 4%, from around 5.25% to 5.5%. I believe the decision to cut rates in March or May, again, largely depends on the inflation number. However, I think that the prediction of 6 rate cuts this year is too aggressive. Considering the current dot plot chart shows that the Federal Reserve member are anticipating 3 rate cuts this year. And personally, I also see maybe 3 to 4 rate cuts this year. This is why I think that some of the market participants, some of the investors might be disappointed. And when investors adjust their rate cut expectation lower, there could be some corrections in the US equities itself. So going back to the main topic, what could upset investors this year? My second point is that interest rates may stay higher for longer. Thirdly, the valuations is quite expensive now. The S&P 500 PE ratio is around 23 times, suggesting that investors may have priced in most of the optimism. Fourthly, the earnings might disappoint. Especially a lot of companies have incurred significant capex on the AI, yet they may fail to turn all this AI investment into profit. Lastly, the equity risk premium is near zero at the moment. And probably let me talk briefly about the equity risk premium. So what exactly is the equity risk premium? is the excess return that investing in stock market provides over a risk-free rate. To put it simply, when the equity risk premium is high, the investor prefer stocks. And when the equity risk premium is low, investor prefer bond over stocks. What I have learned from the equity risk premium is that when it's above 4%, it is one of the better times to buy stocks. However, when it's below 2%, investors will typically prefer bonds over stocks because the stock market isn't rewarding investors for taking risks. Therefore, if the bears really want to push the stock market down, one of the good reasons they could use is the equity risk premium is near to 0% at the moment. However, I don't think stock prices need to come down for the equity risk premium to go higher. I believe that with the Federal Reserve cutting interest rates soon, the decrease in the bond yield itself may eventually bring the equity risk premium higher. So I'm not particularly worried about this. And the stock market has provided many positive annual return relative to negative returns. 72% of the time, S&P 500 posted positive annual total return. So it's good to stay optimistic on US equity market in the longer term. Having said that, if you are shorting the market, try not to stay short for too long. So let's talk about the upside catalyst in 2024. Firstly, we are seeing an increasing number of analysts supporting a soft landing scenario. To put it simply, most analysts think that the Federal Reserve has raised the interest rates just enough to slow down the economy and reduce inflation without causing a recession. So this is considered a soft landing scenario. Or should there be a recession, it's going to be a mild one. The Federal Reserve currently predicts that the real GDP will slow down to 1.4% in 2024, while the US Conference Board predicts that the real GDP in 2024 to be 1.2%. The worst quarterly GDP growth will occur in the second quarters and third quarter of this year, according to US Conference Board. However, you can also see that the slowdown will be just negative 0.7% or negative 0.4%. So it does not look like the US is headed for a hard landing per se. And probably one of the main reasons we are seeing a soft landing, not a hard landing, is the rate cut. Generally, after the first rate cut, the S&P 500 tends to go up in prices. The average return for S&P 500 after the first rate cut is 6.88% after 6 months, 8% after 12 months, and 26% after 2 years. This suggests to you that after the first rate cut, you should probably hold on to US equities for the long term, because the longer you hold, the higher the return. The other things that this table tells you is that if the Federal Reserve cuts rate in March, at the end of the year, which is 9 months later, the average return is 5.87%. Secondly, artificial intelligence, AI, is also driving the stock market. AI is driving the next technology spending cycle. Many companies are spending money to build AI because they also see that AI is helping them to grow their revenues. And companies also know that mentioning AI on the earnings call can lead to an increase of the company share price itself. So last year, AI was mentioned 30,000 times during earnings call. Thirdly, the earnings outlook itself is not bad. The projected earnings per share growth is not expected to be strong in the first half of this year, but in the second half, there will be an acceleration. The entire year earning per share is expected to improve from 217 to 243 in 2024 and further to 274 in 2025. Because of that, I think it could help sustain the PE ratio or even push the PE ratio higher. Fourthly, the US dollar is also expected to go down on rate cut outlook, and this could benefit the US companies. Since about 60% of the S&P 500 companies' revenue comes from overseas, a falling US dollar would also be a tailwind for the US corporate profit itself. To put it simply, every 1% drop in US dollar would increase the earning per share growth by 0.5%. This is why US dollar normally has a negative correlation with the US stock market. All in all, US dollar may go lower on rate cut, and it could help boost the US company earnings. Okay, now let me share with you my S&P 500 year-end target price. In my base case, I expect the S&P 500 to go up by 10% to 5250, providing you a decent return. In a worst case scenario, it could decline by 13% to 4140. In my best case scenario, it could go up by 20% to 5750. In the worst case scenario, I still see a 5% increase in the earning per share. However, instead of PE expansion, the PE ratio may go down to 18 times. In my base case, the earnings will grow by 11% and the PE ratio will drop from 23 times to 21.7 times. And in my best case, the PE ratio will stay elevated at 23 times, but earning per share will increase by about 15%. So let me quickly share with you how I arrive at my best case, my base case itself. Okay, firstly, the S&P 500 generally provides an average increase of 10%, following an annual return of more than 20%. I think most investors are saying that, okay, since the S&P 500 provided a 26% return last year, maybe it's time for a correction this year. However, if we were to look at the past data, 68% of the time after the S&P 500 returned more than 20% in that year, 1 year later, the S&P 500 could still provide an average return of 10%. So this is one of the main reasons I think that S&P 500 could still go up by 10% this year. Secondly, this year is a US presidential election year, and generally the S&P 500 provides an average return of 10% in an election year itself. So it's probably good to stay optimistic in an election year. However, investors may see a drawdown of 13% in a presidential election year. So maybe we will see a drawdown of 10% to 15% as well. So the next question you should ask is, when will the drawdown happen? Okay, here I like to show you the S&P 500 performance in election years since 1960. Based on seasonality, the S&P 500 usually sees a sell down in February to March and September to October. So probably you just need to be careful in the months of February, March, September, and October. But for long-term investors, I think these are some of the better timings to accumulate more quality companies. All in all, I see a 10% increase in the S&P 500 this year, but there will be some sell down as much as 15% along the way this year. Okay, enough with the fundamental analysis. I also would like to take a look at the technical analysis. Okay, let's all take a look at the S&P 500 chart. Very quickly, we could see that the uptrend is still intact for the S&P 500. However, recently, we could also see the S&P has pierced through the upper trend line. So this is why I think that there will be a small corrections to bring the S&P 500 back down to this ascending channel again. Other than that, we could also see that this is an inverted head and shoulder over here. So yesterday and recently the share price itself has already pierced through the net line here. So everyone is probably pushing the S&P 500 to the inverted head and shoulder target price at 4896. So yesterday we could see that the price itself touched the target price and has a minor correction to close at 4868. I'm not surprised if the S&P 500 starts the correction from now. But so far, we could also see that the earnings results are so good. There are some earnings surprises, so maybe there is nothing much to push the price down from here. So if the market participant is not pushing the S&P 500 down, then I would say that it's possible for the S&P 500 to shoot up to 127% of the Fibonacci extension first to 5111, or even shoot up to 141% at 5223, or even 161% before we really encounter a meaningful correction itself. Yeah, so maybe I'll be looking at 127% or even this price before we looking at a meaningful corrections. Okay, let's talk about investment strategies. Okay, the key themes to invest in this year is AI. And the key beneficiary is still the Magnificent Seven, namely Microsoft, Apple, Amazon, Tesla, Alphabet, Nvidia, Meta platforms. They are the large cap AI companies with the ability and cash flow to spend CapEx on developing AI. I will talk more about them in my next webinar 2 weeks from now. So look out for that. Other key AI players you may also consider are AMD, TSMC, and ASML. I find AMD interesting, even though it only holds a relatively small market share of 10 to 20% in the GPU market. I believe other companies will try to give AMD more orders now. They will try to place orders with AMD to diminish the strong pricing power that Nvidia has. So AMD is supposed to do better this year. TSMC lagged behind other AI players last year because AI only accounts for about 6% of the total revenue of TSMC. However, the contribution from AI chips, the contribution of revenue from AI chips is expected to increase to 13% of the total revenue over the next 5 years for TSMC. So this is one of the reasons I like TSMC. In any case, if you are interested in AI, these are the main players you should consider including in your portfolio, especially the Magnificent Seven. Last year, S&P 500 went up by 26%, and the Magnificent Seven stocks were responsible for 60% of the total gain of S&P 500. The year-to-date return this year is 2.1%, and once again, these 7 stocks accounts for 55% of the total return itself. Okay, and just remember that these 7 stocks accounts for 28% of the S&P 500 weight. So it's quite hard to push the S&P 500 up without pushing the Magnificent 7 stocks. You could also see that one of the reasons investors continue to favor Magnificent Sevens this year is because their revenue is projected to grow at a CAGR of 11% for the next 3 years itself, compared to the remaining 493 companies going at a CAGR of 3%. So despite everyone says that these 7 stocks are crowded trade, I would say that investors have no choice but to go back to these 7 stocks. Okay, so other than these AI-related companies, you could also consider small cap companies as well. They have lagged behind the large cap stocks in terms of performance in the recent years. However, with the rate cut expectation this year, investor may really regain some interest in them. The small cap stocks struggle in the past few years due to high interest rate environment, because higher interest rate increase their borrowing costs, and many of them are not as cash rich as the large cap companies. And they are also having expensive valuations as well, which make them more sensitive to the higher interest rate. But with the rate cuts happening this year and an expected increase in the market breadth, small cap stocks like the Russell 2000, which is the IWM ETF, may benefit. Okay, but I also like to remind you that these small caps companies are more volatile and risky in nature. So therefore, you may like to consider investing less than 3% in IWM ETF. Alternatively, one of the easiest way to invest in this market is to invest in S&P 500 ETF and Nasdaq 100 ETF itself. Last year, the S&P 500 and Nasdaq 100 returned 26% and 55% respectively. If you find it challenging to outperform the broader market return, investing in this ETF would be one of the better options here. You may also like to consider some risk-on sectors as well, such as semiconductors, technology sectors, and the communication sectors itself. Okay, here I'd like to share one aggressive portfolio that I constructed. And this portfolio mainly consists of growth stocks such as Apple, Microsoft, Nvidia, Amazon, Tesla. However, I've also included some of the defensive stocks such as Costco, Visa, McDonald's, Coca-Cola itself. The basic idea behind constructing this portfolio is AI focus, avoiding exposure of more than 15% in a single stock. Additionally, for some of the risky counter like Pinduoduo or Block or even IWM ETF, I aim not to invest more than 3% in any one of them. Okay, but again, I reckon most investors would think that the market is near its high now and do not know how to invest. Again, one of the easiest way is to start investing is to adopt the dollar cost averaging method. You can use the auto invest function at Tiger app to invest a fixed dollar amount in these stocks at regular interval. That way you do not really need to care about the market timing itself. But let me share with you some of the methods I use to invest, and it involves a bit of the market timing. Okay, strategy number one, split your investment into 3 tranches itself. For instance, if you plan to invest a total of 300,000 in the market, you can allocate the first 100,000 into the stocks according to the weight of the portfolio first. This will allow you to at least capture some of the market return. And for the remaining 2 tranches, invest them in the market when the share price goes up or down by 10% to 20%. If the market is down by 20%, if the market is down by 10%, invest another 1/3 of your money. And if it drops further by 10%, invest the final 1/3 of your investment amount. Okay, strategy number 2. This strategy is a bit more complicated. Firstly, you need to identify stocks that you believe are trading near their low or still cheap in valuations, or have not going up so much in share prices compared to other stocks in recent years. So making them relatively cheap itself. You can choose to fully invest in these stocks. For instance, if you have, again, 300,000 to invest, and certain stocks like Block or IWM have been lagging behind other stocks in the past few years, so it may be worthwhile to invest fully in them according to the weight that you assign. For example, you can fully allocate 3% of your 300,000 investment amount into Block, amounting to $9,000. On the other hand, for some of the highly volatile, overvalued stocks like Nvidia, if you intend to invest 9% of your total portfolio into them, you can start by investing 3% first and wait for market timing. Wait for a better market timing to invest the remaining 6%. Regardless, these 2 strategies itself help you to start to really get started with investment to at least capture some of the market return. Lastly, if you believe that the market will fall and you would like to hedge your portfolio risks, some people prefer selling the stock first and then buying back later. For example, if you anticipate a 10% market crash in the next 1 month and probably think that Apple share might fall by 20% in stock price, investor may sell Apple and wait to buy back after it falls 20%. However, I normally do not recommend selling your stock first and buying back later, especially for those good quality companies. Because after they sell, they may not be able to buy it back. Either Apple doesn't decline as much as 20%, or when Apple drops by 20%, investor simply does not have the guts to buy it back. So when Apple goes back up in prices, a lot of investors will just miss the boat forever. This is why I do not recommend selling first and buying back later. If you think that the risk is too huge and you cannot take it, I would suggest buying put option, buying protected put, investing or maybe investing in gold ETF, or investment grade bond ETF such as AGG, BND ETF, or considering buying some of the inverse ETF to hedge your risk such as SQQQ. Okay, lastly, let me give you my conclusion. I think that the US stock market will provide you some decent return this year, perhaps just around 10%. But gaining another 20% this year might be a bit challenging. And there could be a drawdown of 10% to 15% this year, either in February to March or September to October based on seasonality. However, I do not think that you should be 100% in cash at the moment. You do not want to be 100% sitting on the sideline and wait for it to come down to invest, because the corrections or drawdown itself that you think might happen might not happen. So I always say that investors should be at least 70% invested in the market and use the remaining 30% for short-term investment. Okay, I believe I have run out of time. Okay, that's all for me today. I will move on to the Q&A session. So if you have any question, you are welcome to ask. You can put your question in the chat box itself.